Hey everyone, in this video we're going over a brand new stock I just purchased for the first time today. I purchased over $250,000 of this stock. This stock is a value play. We're going to go over into the details, but before we do, if you could smash the like button, it really helps the YouTube algorithm. And if you haven't subscribed yet, please subscribe. Let's get into it. So I just bought this stock. I think this could be one of my top value plays yet. Now, there's definitely some growth here, but this is not one of my growth plays. If you're a growth investor, this might not be the stock for you, but if you're looking for a value play, I really believe this is a very cheap stock. So that stock we're going into is Sprouts Farmers Market. Now, the numbers look amazing. We're going to dig into the earnings. We're going to dig into an investor's update they did earlier this year. We're going to come up with some assumptions and what a fair value for this stock is. If you've never been to a Sprouts Farmers Market, I put some photos now just so you can see what it looks like. Personally, I've never been inside a Sprouts. I've just done my research online, but if you've been to one, definitely comment below. Would love to know your experience. As far as the ticker, it is SFM. They had Q2 earnings last week, so we're going to go over that. We are going to build a better understanding of their business through the earnings and through some of the commentary that management has given through an investor update. So let's get started. The first thing I want to go over are the amount of locations. So when I looked into on their website how many stores they have, I counted 383 locations based on just these numbers per state. Many of these states just have 1 or 2 locations, so there's a lot of room for expansion. In California, there's over 130 locations, by far the most. We have 32 locations in Florida, 44 in Arizona. Lots and lots of room for growth. Now, they discuss focusing on optimization of their stores. So they have a new store format, which kind of highlights new fresh products, this treasure hunt experience, which we'll go over a little later, but basically finding new types of products you wouldn't find elsewhere. It costs 20% less to make these new stores versus older stores they were building. A lot of that is because instead of a 30,000 square foot layout, they're now doing 21 to 25,000 square feet, so smaller size, focusing more on the products that deliver, not the products that don't sell as much, and wherever they can find growth. So some of the benefits they show for having a smaller store is it's a lower cost to build, reducing, like I said, non-selling space, so areas that just don't have products that sell much, decreasing the occupancy cost, and reducing the operating cost as well. And if they believe, the same amount of sales in that space, it's going to provide a better return on investment, which will then allow them to accelerate their growth into the future. So they have this treasure hunt experience they talk about, which is basically they want to have these exclusive products that you won't find anywhere but at a Sprouts. One product they highlight is a product from Pipcorn, which I believe was on Shark Tank. I could be wrong, but just from my memory, I think it was. And they have a certain flavor that is only available at Sprouts. Now let's get into the numbers. The numbers are the reason I'm investing in this business. So that's basically the bottom line. When we look at SFM, this is a market cap of $2.87 billion, currently trading with a price to earnings of just 10.57. When pulling up the forward PE, the forward PE is not far different. It's about 12 right now, with the trailing PE being basically what it is, 10.13. Price to sales of under 0.5. This is a 0.44 price to sales. So very, very small price to sales, but it can be expected for being a grocery store to have a low price to sales because of the low margins involved in this business. Now, I do want to show you, though, how Sprouts holds up against other grocery stocks. For example, Kroger has a PE of 22. Albertsons has a PE of 19.65. And when Whole Foods was a public company before being acquired by Amazon, it traded for a PE between 20 and north of 40 for many years. From 2012 until its acquisition, there were times the PE was above 40, but it was always basically just under or about 20, a little higher than 20. So at a PE of 10 or a forward PE of 12, this stock is very cheap in comparison to its peers. Now, ongoing strategic changes are producing solid year-to-date financials. They bring this up showing that year-to-date, they did about $3.1 billion in sales, which is much, much better than the same time in 2019. Obviously, it is a slight decrease versus 2020, Now, we would expect a decrease versus 2020 since in 2020, people in the first 6 months were hoarding products at the supermarket due to the pandemic. So obviously we wouldn't expect that kind of level of sales, but it is extremely impressive that they came close, over 3 billion in sales, 3.1 basically, versus 2.8 billion in the first 6 months of 2019. Now, as far as EPS, similar, slightly less than 2020 levels, but in comparison to 2019, far better. They had 76 cents in adjusted EPS in 2019 versus $1.22 in adjusted EPS the year to date for 2021. So these earnings and sales are much better year over year in comparison to 2019 if we're going 2 years, and very competitive to 2020, which would be unexpected. So I am happy with these numbers. Now, looking at the year-to-date earnings before interest and tax, as well as the earnings before interest and tax margin, we can see that it's 6.4% compared to 2019, which is really the comparison I like to look at right now, is going from 131 million to 197 million, but more importantly from 4.6% margin to 6.4% year-to-date, very close to the 6.8% we had in 2020. And it is nice to see it holding above 6%, since from 2017 at 5.9%, there was a slight decline down to 4.6%. And now coming back up from 2020, I like that it is holding above 6%, and I will keep an eye on that margin percentage going forward. Now, the next thing I want to go over is that e-commerce is playing a bigger role, and purchases from the app for store pickup and delivery are growing. The penetration they have on e-commerce is above 10%. So there is a fair amount of people using their app. Out of all sales, 10% of it is coming from online. That is a great rate. I like that it's holding there, and we'll be following that to see if that increases or not. As far as their annual outlook, their sales are expected for 2021 to be down low single digits in comparison to 2020, but this is something that many people expect, obviously, because, like I said, lots of people were hoarding products in 2020. So having anywhere near the same amount of sales as 2020 is a big positive in my opinion. Low single digits difference is not bad to me. As far as adjusted earnings before interest and tax, they're expecting 305 million to 325 million. That's a great number in comparison to their market cap of under 3 billion. So they're going to have less than a 10 times adjusted EBIT, earnings before interest and tax, to market cap. The adjusted EPS of $1.90 to $2.02, CapEx of 110 million to 125 million, and approximately 25% tax rate. Now we get to look at the overall year-over-year trends, which is much more important. Just going long history from 2011 until 2020, the revenue had some really awesome increases. If you want to, you can pause the screen, but you can see all the way to the right, 2011, 1.1 billion in sales and revenue. That increased year over year, every single year, all the way up to 2020 of $6.47 billion in revenue last year. The gross profit also obviously increased as revenue increased. Net income has more than doubled in the past 5 years. And in the first half of 2021, we had 144 million in net income. And if the second half was the same as the first half, we'd have 288 million, which would be slightly higher net income than 2020. So, it remains to be seen how the net income is for the second half. But this is just showing you that the net income is remaining stable for a extremely positive year in 2020, which is great, and I expect from then going forward to continue having growth. A lot of that is because of this right here. In their investor deck, they were showing, one of the reasons to invest in them is that they're targeting 10% annual unit growth beyond 2021, with a lot of white space, plenty of areas to grow that they have not hit yet. 10% more stores every year they're expecting. Now, I put this slide up about ESG just to kind of say, ESG, taking that seriously is an important thing in general. But what's also important in the investment world is that more and more funds are only investing in companies that have high ESG ratings. So the fact that SFM takes this seriously is not only good for the world, but it's going to be good for them as an investment. It is helping out their sales currently, they say, and also investors will definitely appreciate it, and it will be allowed into more types of funds because of it. Now, this company pays its employees well above minimum wage. The average store team member is paid $17.42 an hour. They have a diverse workplace. They mention 48% ethnically diverse, 51% female, and they promote from within. 72% of their store managers are positions from internal candidates that basically got promoted. So it is good. They want their employees to stay for the long run. Now, they have a very large total addressable market. Consumer spend at food for home is $1.2 trillion. They believe that their target customer is a $200 billion plus market, and they have a very, very small share of that market today. So there is a lot of room to grow. Now, the bottom line is this company trades cheap and it has ample opportunity to grow. That is the only reason I'm investing in them. Besides all the good things about them, it can be broken to the single sentence. The company trades cheap and it has ample opportunity to grow. There is nothing else needed to be said for me to make an investment if that sentence holds true. Now, investors buying today are also buying while 20% of the shares are shorted. As a percentage of the float on July 15th, it was 19.39% short interest. These shorts will ultimately have to buy back the shares. Now, I am not buying because I'm expecting a short squeeze, but 20% of shares being shorted is a massive amount of shares being shorted. This is something I thought I should bring to your attention. Since this company is a cash flow positive company and it's profitable, there's no reason this company would go under, in my opinion. Hence, these people will have to cover their position. Now, lastly, I just want you to look at this trend and tell me what you think is going to happen next. On the left, we have their annual revenue in green, and we have their earnings basically in blue. Do you see the trend going upward or downward? I mean, it's a pretty clear trend to me. And on the earnings on the right, I mean, what do we see? Beat, 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 beat. Do you expect their next earnings to be a miss? I mean, I don't know. I'm just saying this company has historically beaten expectations. It has historically risen its revenue, and I expect it to continue to do the same. So now this is where we have to get to. We have to make assumptions and figure out what a fair price for this stock is. Now I'm going to walk you through my assumptions. We have the historical numbers on the left, and then we're going to have my assumptions on the right filled in. First, we have revenue growth percentage. So last year they grew revenue by 9%. Over 5 years, they had revenue growth of about 11.2% per year. I'm expecting a low percentage of revenue growth of 7%, mid 8%, and high 9% for the next 10 years. This is a 10-year forecast that I'm making, and I expect because they're going to be opening 10% more stores each year, that is what management said, I'm expecting 7, 8, or 9% growth in low, mid, or high. As far as share count, they are doing buybacks. So I put in the worst case, no buybacks. Best case, 1% of shares bought back. Actually, I'm sorry, that was mid case. Best case, 1.5% of shares bought back per year. Now, on average, they bought back 5.7% over the last 5 years. Last year, their profit margin was 4.4%. Over the last 5 years, they had an average profit margin of 3.4%. I put a low assumption of 3, a mid assumption of 4, and a high assumption of 5. Only in the high assumption does it slightly beat its past profit margin, but mid is lower than last year. Now I'm expecting a PE, or a price to free cash flow, of 12 at the bottom, 13 for the mid, and 14 for the high. All much lower than the peers' price to earnings we discussed before, which average around 20. Now the desired annual return I want each year for the next 10 years, I put as 10%. So now if you'd like, you can pause the screen. You can see all these numbers I put in. You can decide if you feel they're fair or not. To me, I felt these were pretty fair numbers. Now the question becomes, what should we pay for the stock today in order to return 10% every year for the next 10 years, assuming that these assumptions come true? So once I put these assumptions in and I hit calculate based on these assumptions, I basically got this. If we're looking at price to earnings of 12, 13, or 14 based on the assumptions I put, this stock is worth $28 up to $69 on the high side. If we went off of price to free cash flow, it's worth about $26 up to $48. Now, obviously, this is a wide range, but we're also putting, there's a huge difference over 10 years if you compound at 7% growth or 9% growth, as well as if you have a different profit margin, etc. What was important to me is I believe that the stock at a worst case scenario is still worth slightly higher than it is today. Today it's trading for $24 and change. Worst case, it's worth $26 and I'll still get 10% every year based on my assumptions at the bottom case scenario. Best case, about $70 a share. Now, I wouldn't pay $70 today, but I believe it is worth somewhere between $35 to $40 right now. So buying it at 24 is very cheap in my opinion. And then you will make that 10% a year, assuming these assumptions come true. So, at 24 and change, it's very cheap. I looked at tip ranks to get an idea of what other analysts think. And I did this after I did all my assumptions, and the highest price target for the next 12 months was $36 and the lowest $25. So like I said, even the lowest price target on tip ranks is slightly higher than today's price. The average price target on tip ranks is about $29, which is about 19% upside, and the high price target, like I said, $36 on tip ranks. So my initial purchase today was for 10,000 shares. I ended up adding additional 2,500 shares before the market closed. So my total amount of stock is 12,500 shares of SFM bought today at an average price of $24.41, equaling over $300,000 in this stock. Now, if this stock goes lower, but their earnings remain strong, I am willing to build this position to about 20,000 shares, so almost double what I currently have. That is what I'd be comfortable, about a $500,000 position at a lower price point. And I think basically at today's level for the stock, I believe it's about a 10% a year at minimum return that I'm going to make. So I feel confident owning these shares instead of cash. Now, I think there's a good chance that the market revalues this stock over the next 12 to 24 months. It gets a slightly higher price to earnings, and that could bring the stock up a fair amount, maybe 30 to 70% higher than it is today. Upon my research on grocery chains, I've also noticed there is a lot of mergers and acquisitions in this space, so I wouldn't be surprised to see a $10+ billion chain acquire SFM. Now, just so you know, Kroger's is over $30 billion. This company is under $3 billion, so there is a lot of room to grow in this space. I feel very confident holding this company for the long run. I believe it's a better place than holding cash. Please like this video if you've made it this far. If you haven't subscribed, please subscribe to the channel. Follow me on Twitter or Instagram at FFMResearch. Thank you so much for watching, everyone. Please comment below what you think of this stock, and feel free to let me know if there's any stocks you think I should look into. Until next time.